Well, good morning and welcome to the Reserve Bank. With me I've got Grant Spencer, who's the Deputy Governor and heads our financial stability work within the bank. New Zealand's financial system remains sound. The banks are well capitalised and have strengthened their funding base. The main threat to the financial system is the risk associated with imbalances in the housing market. Household debt is high relative to historic and international norms, and house prices are very high by international standards and are rising rapidly in parts of the country. If left unchecked, excessive increases in house prices increase the likelihood and potential magnitude of a correction in house prices following an economic downturn. We've seen in many countries over the past 3 decades the damage this can cause for households and the banking system and the broader economy. The Reserve Bank has responded to this in 2 ways: by requiring banks to hold more capital against their high LVR lending, and by introducing speed limits on the proportion of high LVR lending banks can undertake. These policies seek to slow housing lending and slow house price inflation and reduce the potential risks to bank balance sheets. It remains critical that the government and regional authorities continue to address the supply side issues. It's too early to assess the impact of LVR restrictions on demand. They were introduced 6 weeks ago. But many banks have increased their low equity premia, introduced 2-tier pricing of loans, and tightened their lending criteria. On a seasonally adjusted basis, there was a slowdown in housing loan approvals in October and a reduction in house sales. But one shouldn't read too much into this at this point. Let me hand over to Grant for some comments.
Apart from the housing, the main risks we identify in the report are the high level of debt in the dairy sector and the high level of external debt overall. The dairy sector is currently enjoying export prices that are very high, but its high gearing does make it vulnerable to any fall in prices or an increase in interest rates. Farmers have generally adopted a cautious approach in recent years, and this will need to continue for debt ratios to be reduced. New Zealand's high external debt as a country reflects persistent balance of payments deficits over a long period. While the improvement in private savings and low investment in recent years have reduced the external deficit, this trend is likely to reverse as new investment picks up. It's therefore important that the private savings improvement is maintained and that the public sector deficit continues to reduce. Much of the country's external debt is issued by the banks, who have reduced their reliance on offshore funding since the GFC. The worsening of the country's external payments position will reverse this trend and cause the banks to become more reliant on the international markets, thereby making them more vulnerable to financial shocks. On the policy front, over the last 6 months, the Reserve Bank has continued to enhance the prudential framework to further strengthen the financial system, and some of the key developments have included a review of the non-bank deposit taker regime, which was completed in September, a review of the oversight regime for payment and settlement systems, which we intend to strengthen, and a new prudential regime for the insurance sector, where we now have 99 insurance companies under licence. Thanks. So, open up to questions.
Governor, Patrick Gower from 3 News. What's your message to those first home buyers out there unable to raise the 20% deposit and get into the housing market?
Well, we understand why some borrowers are disappointed, but in the central bank we need to look at the risks to the financial system and to the broader economy. And we've seen large declines in house prices at various times in the advanced economies, and we've put a graph in the Financial Stability Report just showing over the last 30 years some of these very substantial house price adjustments that have occurred. They can have a major impact on the economy when they do occur, and it can take years to restore economic growth and impose considerable hardships to homeowners as they reduce their consumption and try and build up their savings. So we're concerned about the systemic risk. We also saw banks lending very aggressively to borrowers with low deposits. I mean, it was almost a third of total lending on households, and trying to slow down the demand for housing while the supply side starts to pick up with the measures that the governments and local authorities are looking at. We really felt that exempting first home buyers was just too much. It would have made these measures ineffective, we believed.
And aren't you concerned by the anecdotal reports out of the master builders that LVRs are affecting interest in new builds and the obvious effect that would have on supply, and how prepared are you to consider an exemption to LVRs for new builds?
We're taking a look at that, but if you take high LVR lending on new house construction, it's roughly 60 to 80 million a month, right, which is about 2 to 3% of total house lending, which is about $3 billion a month. So while there may be some immediate impact from the LVR restrictions, we expect the demand for new housing to remain strong. The market price for houses in Auckland and Christchurch, for example, is running ahead of the cost of new building. If you look at annual consents, they're currently running at around 50% above the trough in 2011. If you look at the data for October, it was the third heaviest month in terms of new building consents for 2013. But we'll look at it. We'll keep monitoring the situation. But at the moment, this is a very small part of total housing lending, and housing starts are growing quite strongly at this point.
And Governor, what about those reports and analysis earlier showing that house prices may drop in the regions because of LVRs? What are your thoughts on that?
Well, we expect LVRs to slow down the rate of house price inflation. It's currently running at around 16% in Auckland at the moment on an annual basis. We think most of the effect of the slowdown will take place in the markets which are the most intensive, if you like, in terms of price action and where the demand is stronger.
You say you're looking at lifting LVRs on new home building. You're monitoring it. How long is this process going to take? When can the builders expect some relief in this area?
Yeah, I didn't say we were going to exempt it. I said that we'll look at it. But we'll look at the data. I mean, these measures have been in for 6 weeks at this point in time. And as I say, this is a very small part of total housing lending. It's about 2 to 3% of total housing lending. And the consents are growing quite strongly at this point. As I say, they're up 50% on an annual basis over the trough in 2011.
I think it's also fair to say, the banks have cut back very hard on high LVR lending to start with. But as they adjust, then over time they're going to come back into some high LVR lending because they still have this 10% speed limit, right? And so, there's the potential once some high LVR lending comes back in on a sort of a steady state basis, that some of that could be covering new building. Because as Graham said, the new building high LVR lending is only 2 to 3% of total lending. So potentially some of that can be covered within the 10% speed limit.
In the Financial Stability Report, you talk about the restrictions potentially being removed once you see evidence that significant imbalances in the housing market have abated. Can you give us an idea of what sort of evidence you're looking at, how we'll know whether the overvaluation has abated?
Well, I'm not sure we'd have to be totally convinced that the overvaluation has totally disappeared, but I think the main thing will be being confident that the pressures have come out, that the excess demand pressures have waned, and we'll be looking at a number of indicators to assess that situation. In particular, obviously, house price growth itself and credit expansion and other demand indicators.
So does that mean that you'd expect house price inflation to drop the sort of, was it 1 to 4% or so, and the credit growth to drop in the way that you've forecast?
Well, that's our expectation, and then we'll see how the actual experience emerges over the coming 3 to 6 months and the longer period. But yeah, we're looking for the heat to be taken out of the housing market, for rates of house price increase to reduce, not necessarily to be negative, but to certainly diminish, and to, for the heat to be taken out of that market.
Do you have any idea of the time frames of how long you think this policy might have to stay in place if it's to be successful? Are we talking 6 months, a year, a couple of years, longer?
Well, we're not really putting a time frame on it at this point, but we're certainly saying it is a transitional, it's a temporary thing, not permanent.
But the other variables that'll come into play here will be very much what happens in terms of freeing up land, regulatory reform, how much progress is made with the Auckland Accord, how much house building takes place in Christchurch in terms of the 10,000 houses. Interest rate increases will come into effect as well as most likely going to be the case in terms of our forward projections and the monetary policy statement. So there's a lot of things that will affect the demand and the supply imbalance.
I'm trying to recall a period over the past 20, 30 years when the housing market wasn't said to be overbalancing the economy, and I suppose the periods when that's happened have been somewhat narrow and short-lived. So I'm sort of wondering what your criteria is for getting back into balance, as it were.
Well, we can't say much more than what we've said. I mean, we look at the indicators, but we don't have, a red line or a well-defined threshold, and we say once it goes below that, then these things are off. I don't think that's the right way to approach it.
Another question on a slightly different area. One of the things that I suppose didn't happen when you announced these things were coming in was that there wasn't this mad rush of people to sort of get in ahead of the restrictions. I was wondering if that surprised you, and if that's an indicator, and I know counterfactuals are always difficult in economics, but if that's an indicator that perhaps things were starting to become a little bit more sane in any case.
Well, we signalled the policy pretty well. We've been talking about it since early this year, and giving speeches indicating that this was a possibility. So the banks were, I think, aware it was coming, and they were also aware that they had these significant pipelines of pre-approvals. And so they were a bit wary that once if restrictions did come in, they were going to have to handle their pipeline of pre-approval. So I think that was one of the factors behind the degree of caution early on in the piece after we'd announced this policy.
Governor, I just wonder, how comfortable are you that households can cope with mortgage rates of up to 8%, given that there is high levels of indebtedness already in the household sector?
Yeah, there is high levels of indebtedness. I mean, if you take the household debt as a proportion of household disposable income, that ratio was around 60% at the beginning of the 90s, and it's now around 146%. You know, I think there's a set of householders out there, or house owners, that really haven't experienced downward adjustments in house prices. They haven't experienced increases in interest rates. And I think for many, there's an expectation that house prices will just continue to rise. So we've signalled in our monetary policy statement, given the strength of the economy and how we see that unfolding over the next 18 months or so, we expect to be increasing interest rates, and those interest rates will certainly raise the debt servicing costs and especially affect those that have low equity.
Do you think, though, it's going to manifest itself in higher mortgagee sales in the future?
That I don't know.
In our report, on page 23, we actually have a box, which shows the impact potentially of higher interest rates on debt service ratios for households. That graph is on page 24.
And
but
you do note that that's very close to where it was before the recession.
Well, that's right. So, I mean, you know, the household debt has been coming off since the recession. And just recently, I mean, this is our concern, that debt is now starting to pick up again. So if you have on top of that high level of debt, if you have interest rates increasing as well, then that is potentially going to put pressure on the debt servicing capability of some of the borrowers who are in the market today. So, you know, hence our warning.
So there is a strong possibility then that mortgagee sales could rise quite substantially?
Well, they could certainly rise. I'm not sure substantially. They have been, you know, coming down recently since the GFC, and you know, that's very positive for the banks, but we have to be forward-looking, and that is a risk.
One for the Governor on the role of monetary policy and asset bubbles. Central banks are grappling with the problem of very low interest rates, in theory, pumping up asset bubbles. Do you think there's a role here for the Reserve Bank to use monetary policy, i.e. higher interest rates, to deflate or burst an asset bubble? This is independent of whatever consumer price inflation is doing at the moment or in the future?
Well, I think the concern, if you have asset bubbles, and to use your terminology, is what happens when the asset bubble bursts in some way. What does that do to demand in the economy and to unemployment, etc.? People found, I think, in the global financial crisis that, in essence, interest rates being very low and fiscal policy being very prudent and economies growing at around the rate of potential output or even faster really just couldn't deal with asset price bubbles, hence the need for macro-prudential instruments. What we're seeing in New Zealand is, perhaps in some respects, we're a bit ahead of the economic cycle and the financial cycle in some other countries. I mean, if you look at some house price inflation in Australia, in parts of Australia, Sydney and Melbourne, if you look in London, it's quite possible that the regulatory authorities and the central banks will be facing difficult decisions over house price inflation and how to rein it in. And my guess is they will look at all the tools that they have available to them, one, in terms of macroprudential policy, and two, interest rate policy to try and stem demand. The problem we have here is it's a combination of supply shortages plus the excessive demand. We can do certain things on the demand side to try and help with that equilibration, but it's critical that that we get the adjustments on the supply side, and particularly around the cost of housing and the regulatory reforms needed to free up sections. We need more of the 6,000 sections, for example, that were freed up in Auckland recently.
But would the Reserve Bank increase interest rates to burst a bubble here?
Well, yeah. Okay.
I'd note that in the recent change in our policy targets agreement, we do have a clause in there which says that monetary policy in targeting price stability should also have consideration for financial stability. So, there may be situations where monetary policy does need to take account of potential financial stability risks. And that may mean leaning against a housing cycle, for example, even though there may not be huge inflation risks arising from that. But I would slightly differentiate from leaning against a cycle to trying to burst a bubble. I don't think monetary policy would be trying to cause a collapse in a housing cycle, but it would certainly be trying to moderate it.
Is that an option then, to lean against a bubble if this ILVR target doesn't work?
Well, I think the likelihood over the coming period is that we will be being required to increase interest rates to moderate inflation pressures generally, part of which may be pressures in asset markets. I think in the coming period, those two objectives are probably going to be quite consistent and aligned in terms of the monetary policy and macroprudential.
You've pointed to the risk in the dairy industry and the risk of a downward correction in commodity prices. Do you have any tools or mechanisms that you could use or implement if you did see credit growth growing quite strongly in there and that became a concern for you?
In the dairy sector? Well, we do have in the macro-prudential toolbox that we introduced earlier this year. We did talk about the possibility of sectoral capital requirements, for example. So, there's certainly the potential, if there is pressures in one sector, such as the dairy sector, to target those pressures with the macro-prudential policy.
What would those conditions have to look like in order for you to introduce those?
Well, as I said at the introduction, we're sort of cautioning at present. We don't have a real concern because credit growth has come off. Farm prices have dropped quite a bit from the 2007 peak. Dairy farm prices were down 30% or so. And so we don't have the same degree of overvaluation still in the market as we do, say, in the housing market. But so while things are quiet at present, and prices are good, export prices are good, if things really start to pick up in terms of credit and land prices back to the sort of boom periods, then we'd have to start considering whether to try and lean against those to reduce the risk in that sector. Because if there was a sharp downturn in commodity prices arising, say, from a downturn in China, then you could have a major impact on that sector with the debt levels that it has.
See, dairy debt has trebled basically since the year 2000, so it's gone from about 10 billion to 30 billion, and roughly 50% of that debt is owned by 10% of the farmers. So that's where the exposure really starts to bite if you did get a decrease in commodity prices.
I know you just touched on this briefly before, but you do say that LVRs are a temporary measure, and obviously there's a possibility of raising interest rates to cool the sort of house price inflation. But what's the next tool in your box that you would turn to after those?
Well, we have monetary policy tool, the OCR, the official cash rate, and we have macro-prudential tools, and we have a range of those. But you know, that's as far as it goes. I guess your question may have been other potential.
You've got the LVRs, so what would be the next thing you'd use apart from looking at interest rates?
Well, I mean, there could be use of other macro-prudential tools, but at this point, we're certainly not considering throwing other instruments at the problem.
You've pointed out that household indebtedness is rising again. I'm just wondering, how are households going to fund all this new house building without increasing their household indebtedness even more?
Well, as Graham mentioned, the amount of that credit, that increased debt that's actually going on new construction is actually quite a small percentage. So most of the debt that's being created is people trading houses going around in the secondary market. So, you know, moderating the growth of that debt doesn't mean that to say it has to put a damper on new construction. If the incentives are there for supply and new construction, you know, that'll happen, and there's enough credit to support it.
Sorry, another question on the timing of LVRs and etc. Is there a minimum time period at which you'd need to know it? They'd need to have been running at least this amount of time before you'd sort of say, well, yeah, they're working or they're not working or whatever.
We've said that it'll take 3 to 6 months really to assess the impact, because the banks have a 6 month transition period to sort of, you know, their first window to conform with the requirement. So it'll be at least that sort of period to assess how it's tracking.
Another question about the LVRs, Governor. How much stock would you put in the government approaching you or hinting to you that they wanted exemptions on new builds in order to fulfil their goals, political goals, in a sense of increasing house supply? How much stock would you put in messaging from the government?
Well, we have a memorandum of understanding in respect of macro-prudential policy that we've signed with the Minister of Finance, and that has clear responsibilities for the central bank in terms of the undertakings around macro-prudential policy. It also requires us to consult with the government, and we did consult extensively with the government before we introduced these measures. But the government basically left the decision to the Reserve Bank. I'm sure if the government were deeply concerned on any particular issue, they would consult or basically engage with us. There would be a consultation and exchange of views. But the memorandum of understanding has been respected so far.
Actually, on something a bit different, I was just wondering if you could explain the thinking around putting specific conditions on some of the insurers' licences, and just how many of the insurers there are. I mean, you've sort of said that there's 4 who have got specific conditions relating to the Canterbury earthquake solvency and capital requirements. I'm just trying to get a sense as to whether there are any other exposures that you're a bit concerned about for some of the insurers.
No, there are no particular concerns. Toby might have a comment on this, but yeah, some of the companies have particular risk around the Canterbury claims, where there's a lot of outstanding claims. So there have been some additional requirements in terms of solvency margin that have been applied to those companies, but you know, I wouldn't say they represent particular concerns. It's just that circumstance where, you know, there's a major claims series of claims coming up for those companies, and therefore there's risks around what those are actually going to cost them at the end of the day, given that a lot of them involve replacement policies, and so there's potential for claims insurance, for claims inflation.
Right. And are there specific conditions only around the Canterbury claims, or are there some which are set beyond Canterbury?
Toby, do you want to comment on this?
Yes, I can't give you any names, but there are a couple of others that have specific conditions which are basically around the fact that they have unusual different business models, so we've put specific conditions around their solvency margins for them as well. Yep.
Thank you.
Another non-LVR question. On the payments system review, you're looking to put proposals to Cabinet this month. What sort of strengthenings of the payment system would you like to see, or will you be recommending?
Well, it's mainly to beef it up from where we have at present. We have very limited powers, which are really just information gathering. So there's a global trend towards more comprehensive oversight of payment and settlement systems, recognising the significant systemic risk in some of these systems. So we want to allow for that in terms of giving ourselves powers of to influence the policies, the designs, the risk policies of around these systems, in particular in relation to payment settlement systems that are regarded as systemic, which means, that if they suffer a loss or are hit by a shock, that can potentially permeate through the whole system as a systemic effect. And so it's those sort of systems that we will be concentrating on in terms of trying to establish powers that will allow us to manage risk in those major systems.
What impact do you think that might have on how banks run their payment systems or organise them?
I don't think it'll have a major impact on how they're run, no. I think, it's fair to say that those systems, we're happy that they are sound and, well placed right now, well managed. They have good risk management policies, capital buffers, etc., as appropriate. So it's not really addressing risk concerns we have with them right now. It's for the future, so that we have greater confidence that if there's some erosion of the safety of those systems, that we can do something about it.
Could I just clarify a point on the LVRs in terms of the speed limit of 10% of all lending? Do you have a sense of what that is running at the moment? Are you collecting data, and what do those figures look like to you?
Bernard, do you want to comment on that?
Excuse me, we haven't yet seen the numbers for October, which of course is the first month in which the speed limit starts to take effect. I would expect actually in the first few months that the actual speed limit could well run above 10%, but bear in mind we've given the banks 6 months initially to meet the 10% speed limit. There's a pipeline of pre-approvals that we know will be flowing through the system over the next few months that will potentially push them above the 10% initially. So I think it'll be some time, probably March, before we can really assess how the system's travelling relative to the 10% speed limit.
So we sort of have a situation now where the banks have stopped making new approvals for high LVR lending, but because these pre-approvals exist, that they're still flowing through the pipeline, and so actual high LVR lending is continuing, as Bernard said, even though the banks have stopped writing new approvals. And then once that pipeline's been sorted out, then we'll get back to some sort of, some normal position where the banks will once again start to approve a proportion of high LVR loans.
Sorry, just to clarify that, Grant. So if you haven't got a pre-approval, then it's essentially impossible to get a high LVR loan at the moment?
Well, I think that's that's effectively, it's pretty difficult, yes. I wouldn't say it's impossible. Some banks have different policies. Some are making a clear rule. Some are doing it through pricing. And so there's definitely been an increase in, interest rates in low equity margins. And so the difference now between a low LVR and high LVR mortgage is around 50 basis points. And so it's partly price rationing, partly just rules.
One last one from me, I promise. On LVRs, the banks have responded by cutting their interest rates for sub 80% loans. Are you concerned this is a de facto monetary policy easing in a way?
I wouldn't say so, no. I think if you look at, I know what you're saying, there's some lowering of the margin for 80%, less than 80%, and an increase for high LVR. But generally, overall bank margins, I think, are normal. They haven't reduced overall. So I don't think there's a de facto easing of policy implicit in that.
Well, thanks very much indeed.